Oh, there we go. Good evening, everyone. Welcome to the Radnor Township School District Tuesday, November 10th, 2020 virtual Finance Committee meeting. I'd like to welcome everyone. I apologize, we were starting a little late this evening, and we'll start right off with administrative remarks from Mrs. Deco, the business administrator.
I don't have any remarks this evening. Thank you.
Oh, well, then that will be very quick. Mr. Batchelor, do we have any public comment for tonight's meeting?
No public comment at this point.
Alrighty, so then I will ask everyone if the committee had an opportunity to review the October 13th Finance Committee meeting minutes. Is everyone okay with the minutes? All right, I cannot see everyone at once, so let me scroll through. Sarah and Nancy,
I'm okay too, Susan.
Susan, you're muted.
Let's get right underway with our board action agenda items. What we can expect to see at the November board meeting is the approval of the October financial reports. We will be seeing our disposal list. There's a number of books at Radnor Elementary, Radnor Middle School that will be disposed. In addition, there's a series of laptops at the administration building. Mrs. Deco, those are the computers that were damaged in this flood, and we'll perhaps be recouping some money there for the insurance. Is that correct?
That is correct.
Great. Alrighty. For those of you who don't know, we had a pretty significant flood in August at the administration building. And then we'll have two contracts that we can expect to see on the agenda. One is with BBD, our auditor, and that was the fee to complete the PlanCon Part J project accounting. There's two items here I just want to point out to everybody quickly. So Wayne Elementary School, we did a project there a few years ago, and there'll be some accounting that needs to be done for that. And then back in 2007, we built the middle school, Radnor Middle School, and it turns out that it was recently discovered that this accounting, which should have been done maybe 13 years ago, was not ever turned in. So Mrs. Deco worked with the state. I think that was the state, correct, Mrs. Deco? And we're going to have that work done and get it submitted to the state. In addition, we're going to be doing an addendum to our contract with CRES for para substitutes. The education consultant, Mrs. Deco, we already have that on our contract. This is an addition of the paraprofessional substitutes, correct?
That is correct, yes.
All righty. So does anyone on the committee have questions about those items that we can expect to see on the agenda? Yes, Sarah, go ahead.
Mrs. Stern, I just wanted to ask, Ms. Deco, could you clarify for us, when you say we're going to have the PlanCon Part J accounting done on the middle school, can we expect to see funding from the state that we missed out on 13 years ago? Which, by the way, was before your tenure, just in case anyone's wondering.
So what will happen when we complete the PlanCon Part J process is we will get a permanent reimbursement percentage for the middle school project. Right now we have a temporary percentage, and that final reimbursement percentage will likely be slightly higher than what the temporary percentage is. And then what the state will do is they will go back and they will look at every bond payment that we made for the middle school project, whether it's been refunded or not refunded. And then they will reimburse us the difference between that temporary percentage and the permanent percentage. So we have been getting funds all along, but it's been at the temporary percentage rate, and we can expect to see some additional funds come into the district. I don't expect it to be significant because our reimbursement percentage is so low, and then our aid ratio is also very low. So the amount is not going to be significant.
Okay. But the other reason that you wouldn't necessarily have noticed that this was missing is we have been getting reimbursements from the state.
We have been getting reimbursement. And as Mrs. Stern said, I was working on the PlanCon Part H for Wayne Elementary School. And I had a conversation with Jim Grant, who works in the PlanCon division at PDE, who I've had a relationship with for many years. I won't tell you how many because it'll just age me. But he pointed out to me that the middle school was never done. And Jackie and I did some digging, and we actually found a letter from 2011 saying that the PlanCon Part J wasn't finished on the high school, and nothing was done. It was just put in a file cabinet. So I reached out to Carl Hogan and asked him to put together a proposal.
Wow, so it's not too late to go back after the piece for the high school either?
Well, the high school is not a reimbursable project.
Okay, just trying, got it. Okay,
If it was, we certainly would look at that, but in order to be eligible for additional funding through the Plan Con J, it had to be a Plan Con project in the first place. So ISIN, we're not getting any reimbursement for the renovations we did there because that's not a Plan Con project, but Wayne and the middle school are.
okay, thank you.
You're welcome.
Great. Thank you so much for that, Mrs. Deco. Okay, so then our next item on the agenda is 4.2, the draft audit update. I'm going to just have Mrs. Deco walk us through this. So right now, what you're seeing on our agenda is a 2-page, basically the nitty gritty of the finances for the year ending June 30, 2020. But Mrs. Deco, if you could walk us through this and then give us an indication, what should we expect to see at the November board meeting?
So what you have is 2 pages from the draft audit report, page 19, which just is a summary of all the revenues and expenditures broken down by the various different funds. And it shows the revenues coming in, the expenditures going out, and then what the change is in terms of the net change to fund balances. So when we look at the general fund, we can see that there was a surplus in the general fund of $2,263,000. And then when we look at the capital projects fund, which we call Fund 32, the general fund is Fund 10, capital projects is Fund 32, there was actually a decrease of $463,000. The debt sinking fund, that's a fund that we use to make our debt service payments on some of our particular bond issues. It doesn't actually appear on our books. It's done as a journal entry at the end of the year, and it just shows on our financial statements. You can see there that there was a surplus in that account of 580, almost 81,000. And then the non-major governmental funds, those are all those other little funds that we hold. So the scholarship fund, the student activity fund, this community swim fund, all of those where we are the custodian, but the funds don't actually belong to us, fall in that category. And there you can see that there was a decrease, excuse me, of $1,591,000. If we turn to page 50, you get more detail on page 50. And this shows you the difference between what was originally budgeted, the final budget, and then the actual, and it shows the variance. Mrs. Monahan had sent me some questions. In particular, she was looking at the expenses for the regular programs and the special education programs. And you can see there that there was some considerable variances where we didn't actually spend anywhere near what we thought we were going to spend. So in the area of regular programs, there's $233,000 that we didn't spend. And that's directly related to federal programs, specifically the fact that we were looking to go to a school-wide program for Title I so that we could pay for the elementary principal. And that didn't happen until the 2021 year, excuse me, although we anticipated it happening in 1920. And then if we look at the special education programs, there was a variance of $773,000. And that was related to a variety of things, including anticipated supplementals that we weren't able to do. So we didn't pay our teachers and our aides and some of our other instructional people to do some curriculum development and staff development. And that resulted in a reduction to salaries as well as benefits. And then we had some issues related to COVID closures where we didn't have contracted services such as speech, occupational and physical therapy, and paraprofessionals because kids weren't in school. And we also saw a reduction in our tuition payments because kids were not attending alternate placement schools. They were attending virtually or they were not attending at all, which was often the case with special education kids. And then there were supplies and equipment and things like that that we didn't purchase. And in the area of revenues, we had a large variance in state sources where we'd received almost $1 million less than what we anticipated. And that was related to a variety of things, which included our Section 1306 students, where we get subsidy for some of our most, I expensive students who receive special education services from the state, they kick in an additional percentage. And because kids weren't attending for the whole year, we saw a reduction there. As well as in transportation subsidy and nursing services, which we get based on the services we provide. And because we didn't transport kids from March 13th and we didn't provide nursing services, those subsidies were reduced as well. And then because we didn't do some of those supplementals that we were planning on doing, we didn't receive all of our Social Security reimbursement from the state. So that's where those areas are. Okay. And then on page 50, that also shows the change for the general fund, the surplus of $2,263,000. And so part of the audit that we need to do, and we do every year, is talk about the next thing that's on the agenda, which is the allocation, the realignment of the general fund balance, which is Fund 10.
Sure. So Michelle, just before we get into that, I want to go back to page 19, if that's okay. And find out, first of all, does the committee have any questions about this page? And then just ask you kind of a general, I'm going to want to ask you some general questions about this page, just because, these things that we only go over really once a year, I find it always helpful to get a little refresher on some of the sources and some of the particulars of this, but I want to open it up to the committee first to see if anyone has any questions on this page. Just feel free to raise your hands. No? I'm going to start then. So Michelle, can you just walk us through, as it relates to the capital funds project, the debt sinking, and the non-major governmental, the local sources. So I think with non-major governmental funds, the local sources there are going to literally have been families writing checks for the most part, correct, into the various student accounts. But what would be the local sources for capital funds and debt sinking fund?
So the local sources for those two areas, Susan, would be for Fund 32, which is the Capital Projects Fund, where you see that $173,000.
Sure.
That is going to be a combination. It could be a combination of things. It could be funds that were transferred over from Fund 10 as part of the general fund budget over to Fund 32. And then it's also a combination of interest that was earned on any investments held by Fund 32 over in Fund 32.
Okay. And then expenditures from the capital fund. So the support services, facilities acquisition, and debt service. Well, I actually think I know what debt service is, but if you could walk us through what those were. And then the non-governmental, the 49,000, that expense there, some of that I know is the operation of the pool.
That's correct.
Right.
So in the Capital Projects Fund, support services would be anything that we paid for to support projects that we were anticipating or working on within that capital budget. So for example, when we hired an architect to do the feasibility study for the accessibility and wellness project at the high school, that would fall in that category because that's a professional service. A support service is considered a professional service. In regards to facilities acquisition, construction, improvement services, the bulk of that is going to be things like the cost of our school buses that we purchase. That's a very large expenditure that we do every year, and that falls in that area. What also falls in there is things such as equipment rental that we might have needed in order to do repairs, and any repairs that we have done to the building. Those will all fall in there. In terms of debt service, the debt service is any payment that we made out of that fund related to our debt service. So that falls in that area. And that could be a combination of interest or principal or both.
Okay.
And then in terms of the non-major governmental fund, that is totally related to the operation of the pool facility.
Yeah, that's what I thought. And that just what did you just say about the local sources for the debt sinking fund, the 299?
I didn't answer that question. I apologize.
Oh, that's okay.
That's all interest that we earn on money that is in our debt service fund. So we
Okay.
have some bonds that are structured where we actually set aside money over the course of time to help pay for the debt service payment. So it doesn't actually come out of our general fund budget. And those dollars actually earn interest. And that goes back to our QSEB bonds, which are structured differently than a general liability bond.
Okay. And then down in our other financing, I will tell you, I was surprised to see our insurance recoveries amount was so low. I don't know if that was just a timing of when we got some money. And I know that we did refund a bond. We did refinance a bond last year, which is the reason what we actually issued new debt and we paid off the old debt. And there's some of the savings in that refunding. So, you know, I know that had to do with the bond refinancing we did. The transfers in all three of those funds, were those the transfers we did as part of last year's budget?
That's correct. So when you look at the general fund in that other financing sources, you'll see
Sure.
transfers out of 785,000.
Yes.
When you add up those other transfers, the 479 and the transfers in area for the capital projects and the debt sinking fund of 281 and the 25,000, that adds up to the exact same amount. So you have transfers out from Fund 10 that are going into these other various funds.
Now, where do we see that transfer out for debt sinking? I don't recall ever seeing that on our budget articulated in quite that way.
You don't actually see it because, as I stated earlier, the debt sinking fund is a fund that we have, but we don't actually show it on our books. And it's done, any entry that's made is actually done as a transfer out in Fund 10 and a transfer in to, or transfer into the debt sinking fund. So it just washes as part of the audit.
Okay, so the only thing I think I'm not, oh, those are beginning balances. All righty, so I don't know if anybody else has questions about this particular page. Is everybody good with this? Okay. I'm going to assume the quiet. So why don't we move on to page 50, because I really do think that this is where, you know, this is where kind of the rubber meets the road. Is that the expression? You know, this is what last year cost us. This is it. I don't know if does anyone have specific questions? Nancy, I really appreciated those questions that I know you sent Michelle and gave her an opportunity to address some of the questions there. I don't know if anybody has any additionals. I have a couple of questions about this, but I want to defer to anybody else first.
So go ahead, Bradley, if you have questions.
No, I'm all right. Go ahead, Ms.
Okay. So I had a question. I guess I just, you know, I think we as a board understood COVID was expensive. There were lots of unforeseen costs and costs were going up. I guess the piece we didn't really understand or think about maybe was that even though our costs went up, because the costs were different types of costs, we weren't going to get the reimbursements we were used to getting. I mean, I think it was striking to me that it was almost $1 million that the state didn't provide. Was there any other kind of support? I mean, is that what we're seeing in some of the other grants we're getting? I feel like most of those are local and not from the state.
So one of the things, Sarah, that I failed to mention that I did address in the email that I sent to Nancy was one of the very large amounts that we did not receive from the state was for wards of the state. So we do have quite a few wards of the state. Most of them are placed at St. Edmund's School, or we have students that when we send out a 4605 form to document residency so that we can build a home district for a student, the student might be disclaimed. So we might send something to, let's say, Lancaster School District, and Lancaster School District will say, no, that's not our student. So then when they're disclaimed, they also become a ward of the state. So what happened in 1920 was we did not get payment for our wards of the state. And that's a pretty substantial amount of money that we anticipate receiving. Sometimes it takes a year or two for us to get the money, but we're always trying to recuperate those funds. And what happened in 1920 was the state made a change in how wards of the state billing needs to be sent to the state in order to get reimbursed. So we didn't receive any money. And Sue Almer, who does pupil accounting for the district, has been working with the state trying to rectify those errors and issues that occurred with the billing. So we will get the funds, it's just going to be delayed. So what I anticipate we will see most likely in 2021 is we will see a windfall from 1920 and 2021 wards of the state being paid.
Do you have a sense of how much that is? And if you don't have it in front of you, I understand.
It's roughly around $300,000.
Okay.
Because we also receive funds for wards of the state for the school year, but then in addition to that, we also receive it for ELL. So
Right.
Things happen, and then extended school year, we'll receive it for that as well.
Okay.
Bradley, did you have a question?
I'm all right. Thank you.
Okay.
So the only other one I had was just, and I know there's a lot of little numbers that add up to big numbers, but given the deficit in our funding and the increase in our revenues, I was really very pleasantly surprised by the fact that we have, the 2.6 million of excess funding, or 2.23 million, and I know some of that we had budgeted to have to take from our accounts and things like that. But is there anything in particular you want to highlight as the reason that we are seeing that fund balance?
So we hit on a few of the things that actually caused some of those areas. What happened when the COVID closure occurred is we basically stopped spending money at the district level. So if we didn't absolutely need to purchase things, we didn't purchase it. Now, that doesn't mean that there weren't things that we absolutely had to purchase. We needed to gear up on sanitation equipment and things like that. So we had a lot of COVID expenses that we incurred, but we were fortunate enough to receive grants for some of those. And some of the grant money that we weren't anticipating is reflected in this surplus of 2.263. So that's some of the things that happened. What we saw on the revenue side was we saw revenues being very consistent and keeping pace with what they had been in prior years. So due to COVID, we didn't seem to see a reduction in our real estate taxes, our interim taxes, our transfer taxes. Those kept pace. So while our revenues came in substantially higher in some areas, our expenses were significantly down because of the fact that we stopped spending and we also received some grant dollars.
Michelle, with substitutes and professional development dollars, I mean, we had budgeted professional development dollars for last year that all of a sudden in March, we just didn't use, and substitute changes. Is that contribute to some of it as well?
It does, Ken. It absolutely does contribute to it. When you look at the substitute dollars, though, what you want to look at is you want to look at what was the original budget and then what was the adjusted budget, because what we did with some of those substitute dollars was we moved them to other areas in the budget where we had excess costs. So you have to kind of look at it twofold. You have to look at what the original budget was for those things and the adjusted budget, because things get moved around as part of the end of the year audit.
Sarah, are you done with your questions? So funny that you should say that, Michelle, because I'm reading the word final budget and my inference is that those are the numbers that we voted on last June. And that the original budget might have been what you sent us, what you brought to us as a proposed budget. I don't know when it was, that last December, January, whenever that was. And that the final budget is the budget that we actually approved last year.
So
is that not what those numbers are?
It is not. So when you look at that report, the original budget is the budget that was approved at June 30th or whenever we approved the budget for 1920.
Okay.
And then the final budget takes into account all the transfers that we did throughout the course of the year. So every month when we approve those transfers, that's taken into account. And then any transfers that we needed to do at the end of the year to complete the audit. You actually give us permission, give administration the permission to complete those those budget transfers in order to complete the audit report.
Okay. So one of the questions I have about the actual numbers is, do your actual numbers reflect do they reflect the money that we spent on COVID expenses? And do they reflect the grants that we received, both the expenses that we incurred prior to June 30 and the grants that we received prior to June 30? Do your actual numbers here reflect that?
They do. So if we received a grant and we used it on items that we paid for by June 30, it is reflected in here. If I knew about the grant prior to the audit report. So for example, what is included is,
So I'm thinking about that page that we had where the grant money, it's the COVID expenditures grant. It's a couple of items down, but as an example, you know, we got the 263 PCCD COVID safety grant, the CARES funding that we got. Did you get that prior to June 30, the 263?
we did. So the two grants on that COVID expenditure and grant report that we're going to talk about that are included in that surplus of 2,263,000 is the PDE ESSER CARES funding for 327,420. And PCCD COVID safety grant CARES funding of 263,668.
So when I see a variance with the final budget that's state sources, so is that considered state sources or federal sources?
So the grant dollars are considered federal sources.
Mm-hmm.
And then they would have been spent in the area of regular instruction programs in the equipment area.
I'm sorry,
For
I'm
the
not, maybe
most
let me
part.
ask this differently. Did you reflect it as income, as revenue? Or did you just net it out as against the expenses and expenditure?
You have to record it as revenue because it's a federal source. So it ends up on the schedule of federal awards, commonly referred to as the CFA, and you will actually see those dollars on there. So there's a revenue and there's an expense. But remember what I said to you about the fact that the regular programs on page 50, that 233,650 that we didn't actually spend in that area, that's related to Title I, and Title I is a federal program. So the final budget number up above for federal programs didn't actually take into account those grant dollars that we just talked about that we received for COVID. But it did take into account a larger budget for Title I that we didn't actually spend.
Wait, I don't see the 233 that you're talking about.
It's on page 50 under
Yeah.
expenditures.
Oh,
Says
under
re-
expenditures.
And Susan, to actually see what I'm talking about,
Oh,
you
the
would-
233 variance. I'm sorry, I was looking for a dollar amount and it's the variance. Got it.
and in order to see those actual numbers, you would need to look at the details. So you could see what was budgeted for Title I and what was received, and what was budgeted for the CARES grant and what was received. You would see that there was nothing budgeted, and then there was dollars that were received.
Right, but I guess my point is this. So if the CARES money that came through is federal sources, and yet we still ended up with a negative revenue of 48,000, had we not gotten the CARES grant, that negative amount would have been 48,000 plus the 300 something from federal dollars. The 1.2 million that we actually got from the federal government last year includes the 300 and some odd dollars that we got for CARES. Otherwise, that would have been 900,000.
It would have been, but keep in mind with federal program revenue and federal program expenses, the amount that we budget for revenue and the amount we budget for expenses is exactly the same. So it doesn't really have any impact. That doesn't necessarily mean that those were the dollars we were going to get in that given fiscal year. I mean, we would have if we would have been able to move to a county or a district-wide
School-wide.
program at Wayne Elementary School. but we didn't do that. So the Title I dollars that we didn't receive, we're going to receive at a later point in time. They actually just get what they call carryover.
Yeah.
So you don't actually lose them. So I would say not to look at that as being negative necessarily, because you're still going to receive every federal dollar you were entitled to. And you did get additional additional federal dollars that you weren't anticipating for the CARES.
Yeah, no. That's fine. I just was trying to understand that you actually did net it out. Okay, so there's all of that. And then, just kind of looking down what caught my eye with the,
While Ms. Stern's looking, I mean, it's also fair to say, I think, because we didn't implement that program, that new school-wide program, students didn't benefit from those services. So there was neither revenue nor expenditures for the new school-wide Title I framework at the elementary school. And that program will be implemented when we're able to. I mean, well, it wasn't implemented last year. It's coming in this year.
Correct. So we actually implemented it with the start of the school year. So it's been implemented since the kids came back, and we did it as well when we were virtual.
so the other, just as a point of information, the other two areas I just really wanted to get a handle on is refund of prior year's receipts. Down the bottom, other financing resources. Can you walk us through what refund of prior year receipts are? Obviously, the fact that we didn't do the budgetary reserve means we didn't end up using fund balance to balance the 1920 school year. And yet we did have transfers out, an additional $250,000 in transfers out. So if you could just walk us through what those are, or what that was.
So refund of prior year expenses, you can see that there's a very large variance there because of what was originally budgeted and what we received. That can be a variety of things. It can be if we receive a refund, if we paid something to someone in particular. Usually it happens in the area of special education. We might set up a trust account based on a settlement agreement where funds are set aside to pay for certain special education services. And the child may end up turning 21 and is no longer eligible for those services, and those funds may not have all been expended. Those funds come back to the district. We might have done the settlement agreement a year ago or 2 years ago and paid for it in a prior fiscal year. And then it comes back to us when the child turns 21. And so if it was paid for in a prior fiscal year and we received the funds back, we record it as a revenue in that area of refund of prior year's expenditures, prior year's receipts. So the other thing that is included in there is we get rebates from our healthcare coverage, particularly our prescription coverage, because we use CVS. And so we will get a refund based on some of the prescriptions that our people used. That goes in there because that always happens a year later. And then we have a large reconciliation that we do with the intermediate unit, which happens in October. And sometimes we owe money and sometimes there's a large credit that we receive. So we paid for all of those expenses in the prior fiscal year from July 1 to June 30th, but that reconciliation doesn't happen until late in October, early November. And so our audit's already been completed because we close out our audit as of the end of September. So that ends up, if it's a refund to us, it ends up being posted to that area.
Okay. And the transfer out that was 250 more than we expected?
That's directly related to that debt service transfer, that sinking fund. That's part of the audit report that we don't actually show on our books. But
Right.
We don't actually budget for it, but then it picked up as an audit entry.
Because I'm just looking at the debt sinking fund dollar amount and it didn't match that number. That's why I asked.
I can look at that with my work papers. I don't have it in front of me, Susan, but
That's fine.
there might be some interest that was included
Netted,
in there,
made
but
a
I'll
difference.
double check it.
Okay, no, that's fine. All righty. So what can we expect at the November meeting as it relates to the draft audit report?
So you can expect to see the full draft audit report, that thick document that includes the MD&A at the beginning. Management Discussion and Analysis is what that stands for. That is what we call the written accounting of what happened during the fiscal year. It's intended to be for a non-financial individual to be able to read it and understand some of the financial implications that occurred during the fiscal year. We'll include that. It will include all of the fund statements. So you will see statements for not only the general fund, which is Fund 10, you'll also see it for Fund 32, which is the Capital Projects Fund. You'll see it for the Food Service Fund, which is Fund 51, and you'll see it for all of the other funds like the Community Swim Fund and the Student Activity and Scholarship Funds.
Okay.
And in addition to that, we will have Mike Mood. He will come to the meeting and he will walk us through the audit report and answer any questions that board members will have.
Okay, great. If we don't have any more questions about that, let's move into item 4.3, which is the kind of the next part of this, the other side of this conversation, which is reallocation of general fund balance.
Sorry about that. I was just making a note so I didn't forget.
Sure.
So what you have here is you have a summary of the general fund balances. And what we are required to do as part of the audit report is take a look at the surplus that we have. Take a look at our beginning of the year fund balances. So that would be as of, we call it the beginning of the year, but it's really June 30th of 2019. What was the fund balance at June 30th of 2019? That's what you see in that column for the beginning of the year. And then you see the net changes to fund balances. What that encompasses is we have Fund 15 and we have Fund 17, which is our technology fund, that's Fund 15, and our curriculum initiative fund, which is Fund 17. In those funds, what we do is at the end of the year, we take a look at what their cash balance is and any receivable that they have. And we do an adjustment to their beginning of the year fund balance to bring it up to what their cash value and accounts receivable is. So you'll see a significant change there, basically a surplus of $863,929 for those two funds to bring their fund balance up to the $3,486,663. That surplus is coming from a variety of things. We transfer the exact same amount over to Fund 15 and Fund 17 every year. Last year, we actually reduced it because we were asking students to pay some money towards the cost of the computers. And we actually redid the 5-year plan. But what we try and do is we try to eliminate years where we would have to transfer large amounts and years where we would transfer small amounts. We're trying to keep that amount consistent to kind of level it out over the course of time. And then in addition, they got those 2 grants. Those 2 grants were largely, that we talked about earlier, were largely spent on technology purchases and purchase services. So technology came out of Fund 15, and then the professional services, which we did to help our teachers to set up for the virtual learning program, that came out of the curriculum fund, Fund 17. The employer rate stabilization, that's what we have to help us level our payments for the increases in PSERS payments. And we had anticipated using some of that. We did not actually have to do that. So that $44,642 is actually revenue we earned on the money we have set aside in that committed fund balance.
So if I could stop you there, Mrs. Deco. So last year we had in the final budget we approved, we had that budget gap shortfall of whatever it was, 1.3, 1.4 million. and we authorized using 800,000 from the employer rate stabilization fund. Is that what the fund you're talking about now? Because we were able to close that gap in other ways, we didn't actually have to use that fund balance this year, even though it had been authorized with the final budget last year.
That's correct. And then long-term early retirement incentive and compensated absences. This is the area that's combined together. And what that is if the early retirement incentive is if we have people who retired and we agreed to give them, let's say, health care, or they had other payments that they were entitled to as part of an agreement with them, we have to show that on the balance sheet. And then compensated absences is at the end of the year, we take a look at all of the vacation and accrued sick time that people have earned and have the potential to be paid out for if they would retire or leave the district. And it's based on what's in the contracts. And we do a calculation. So every year, the early retirement incentive technically should go down unless a new individual is given some sort of an agreement that includes some early retirement incentive. But the compensated absences likely go up because people can accrue more vacation, they can carry more over. So we always do that calculation. Those funds aren't actually available to us because the thought is if you had to pay them all out on any given day, you would need to have money set aside. So you'll see there that there's an increase of 40,427 to that committed fund balance. So the unassigned is limited to 8% of the next year's fiscal year's budget. So what we do is we take a look at, we're finishing up 1920, we look at our budget for 2021, the expenditures, and what we do is we adjust that to make sure that we keep the 8%. So that's an increase of 139,968. When we add all those net changes up, that comes to 1,088,966. And we compare that to the net change of 2,263,000. And what we need to do is reallocate that $1,174,204. We talked a little bit at our planning meeting about the possibility of setting some of that aside for COVID-related expenses. I know there was some consideration for that. And the general consensus was that we could do that at any time if we wanted to do that. What we have typically done is taken any of that additional money and put it into the committed fund balance in the general fund for capital projects. Leaving it in Fund 10 gives us more flexibility because if we were to transfer that over from Fund 10 to Fund 32, we can't bring it back if we need to use it for some other need, like to close a budget gap, or heaven forbid, we have some large unforeseen expenditure that we might need to use it for. But leaving it in Fund 10, just by a board resolution, you can move it to use it for whatever you like. So my recommendation is that we move that 1,174,000 into the committed fund balance in Fund 10 for capital projects. And in the event that we need to use it for something else, we would do a board resolution to move it.
Nancy or Sarah, Bradley, do any of you have any questions?
And is that allocation necessary to conform to state law on what percentage of unassigned fund balance we have?
It is, Bradley, and it's based on the size of your budget. So the larger your budget, the less of a percentage you can have. And I can share with you the chart. Smaller districts that have smaller budgets can have a much greater percentage in their unassigned fund balance.
Thanks.
Sarah or Nancy? Okay. Michelle, a couple of questions. So the long-term early retirement incentive compensated absences, are the sick bank days calculated into that fund?
We don't actually calculate the value of the sick bank days because we don't really know how many are going to be used. We do show it we show the number of days on our spreadsheet, but we don't actually calculate a dollar amount.
Okay. And the curriculum and technology issues. So the net change of 863 is a combination of our fund transfer from last year, as well as the grant money that we received, correct?
That's correct.
So, but we spent that money. So why isn't it, that money is, where are the expenditures that we used from that fund?
So when we received the grant funds, I actually physically moved those expenditures from Fund 15 and from Fund 17 over to Fund 10. And so because they had previously been spent out of Fund 15 and Fund 17, Fund 10 needed to pay back Fund 15 and Fund 17 for those expenditures that we received the federal dollars from. I didn't want to actually record the grant in Fund 15 and Fund 17. It really needs to be recorded in Fund 10.
Well, Fund 17 and Fund 15 are part of Fund 10, but
they are, but they're actually accounted for separately.
a little different. I know they are, right. Okay. So just looking at this in this scenario, how would we ever spend down Fund 15 and Fund 17?
You will definitely spend,
back.
You'll spend them down because what we do when we try to figure out how much to transfer over, and we're in the process of looking at it again because we've had surpluses in those funds for the last couple of years. What we do is we do a 5-year budget and we look at what the expenses are going to be for the budget that we're preparing and 5 years out. And then we level out how much we think we're going to need in those funds and adjust that transfer. And I've been working with Scott on the technology fund because we had to purchase so many technology devices because of COVID-19. He anticipates that in 4 to 5 years, he's going to have a very, very expensive refresh because we bought computers for all the middle school kids. We, purchased iPads and things like that for the elementary students. And we shortened our timetable on how we were going to do the one-to-one initiative and basically did it all in 1920. So we're currently looking at that, and we'll look at the transfer to make sure that we level out the spending so that we don't have a huge refresh and have a large transfer required over to Fund 17 and
Okay. So just a couple of pieces of feedback for this particular chart. If you could put a date on it somewhere so that we know it, it's something that was presented today. And then just because, I think almost 8 years later, I finally know Fund 32, Fund 15, Fund 17. If you could put little numbers, just reminding people that, that capital projects, this is the committed one, but I think curriculum's 15 and technology 17, but it might be vice versa. It'll just help people get familiar. And the way this chart would look, if you had already decided, and not that it's your decision, but I'm saying that for illustrative purposes. If you had already decided to put the 1.174 in the capital, into committed for capital projects, it would actually be up above, right? Because we're going to do this fund balance transfer for June 30, 2020, so that the final audit reflects the fund balance transfer that you are recommending.
That's correct. It would have been up at the top, but because we were having the discussion this evening, I put it down at the bottom so you could see how much still needed to be allocated.
Right. And just to remind everybody that even if it's within capital projects, at the end of the day, we can use it because it's in Fund 10, we can use it for what we need. So does anybody have strong feelings or questions about Michelle's recommendation or an objection to her recommendation to do this transfer into to capital projects? No? All right. So then we're going to see this on the agenda for November. to do that, because this is kind of the final piece of the puzzle that needs to be done for the final audit. It's one of the reasons we're seeing the draft audit, the audit in its draft form. And all right, so if we don't have more questions about that, then let's move into the next item, which is item 4.4. This should be a quick update. Ms. Monahan, your email this morning was pretty accurate. Michelle, if you want to just go over your first look medical rates.
Sure. So the district actually gets a first look and a second look. We get the first look right around this time, and we get the second look sometime late February, early March. And because we participate in the consortium, they do what's called a 50-50 rating. And what that means is that the districts who participate receive an increase or a decrease based on 50% of their own experience and 50% of the consortium experience. So if you look at page 2, that's actually the Radnor Township School District first look information. And you can see, if you look at that final number down at the bottom, the final renewal action is a decrease of 2.37%. And when you look at page 3, that's all of the districts that participate in the consortium. And the recommended renewal action there, the very last line, is a 0%. So when you combine the decrease of 2.37 with the recommended renewal action for the entire group of 0, you get Radnor's rate, which is on the last page, which is the 2.7%. Our second look rate will not be any higher or lower than the first look, and likely will be slightly lower than what this amount is. But in this case, because this is a negative, it will be a little bit greater decrease, more than likely.
Okay, so this is good news for the budget.
It is good news for the budget.
Slightly lower medical rates. Yes, Nancy, go ahead.
I just have a quick question. Now that it's kind of been explained to me, I didn't quite understand how this was laid out. But the second page, I guess it's the Delaware County Public Schools. At the bottom where it has minus 3.26% renewal action, but the recommended renewal action is 0. Why isn't it 3.26? Minus.
It's not 3.26 because of the reserve adjustment that's up above. That reserve adjustment is 0, and that's actually what drives that recommended renewal action.
Okay.
Plus, which isn't this an aggregate of all the schools, Michelle? And it's not like Delaware County Public School pays their rate. It's actually, this is the aggregate of what all the school districts experienced, correct?
And that's correct. And every district is going to have their own rate.
Right.
There's different coverages that districts have. So every district is going to have their own rate for all the different levels of coverage that they have. Radnor, everybody is on the same plan. It's one of the things that Todd worked very hard to make sure occurred, is that everyone was on the same plan. So we pay the same rate for every group that we have.
Right. So kind of the aggregate would have gone down by the 3.26%, which actually kind of suggests Radnor used it a little bit more than some other districts, because our recommended premium decrease is less than what the aggregate for the county is.
That would be correct.
All right. Nancy, are you good with that? Okay. Bradley and Sarah, you good? All righty, good. So that is the good news for that is that it bodes well for it's a nice start for the budget. All righty, the final thing that we're going to go over and is this spreadsheet for COVID expenses and grants, which we kind of did reference a little bit. And I know we're running late. Finance started late. We'll try to wrap this up rather quickly, but thank you for pulling this together. It's been a question for a lot of people. Michelle, just kind of what has this world of COVID been for us? So if you want to walk us through this a little bit.
So this spreadsheet is set up in 3 sections. The top section includes actual COVID expenses that the district incurred between March 13th of 2020 and October 30th of 2020. It actually runs across 2 fiscal years. And you can see here in the various areas, technology, and then you see all the things that it included: computers, tablets, other hardware, internet connectivity, and supplies. That was our largest area of expenses. We incurred $1,173,000 worth of expenditures. A lot of that was related to technology equipment that was purchased to do one-on-one initiative, as well as new computers for our teachers to do virtual learning. In the area of PPE, you can see all of the things that that includes. It also includes building modifications, which would include things like plexiglass, automatic door openers, all of those kinds of things, adjustments for the water fountains. All of those things are included in this area. That was our second largest area of expenses, nearly $310,000 worth of expenses. And then salaries, overtime, and professional services. So we did have some salaries that we needed to pay for staff development. Although we weren't able to do some of the staff development we wanted to do, our focus was on staff development to make sure that virtual learning could occur when we wanted it to start up in the spring. And then we had additional substitutes for nursing services to provide additional nursing supports in the buildings. We continue to have those expenses. We had subcontracting costs for paraprofessionals. You probably recall from Todd's conversation that we have moved a lot of our staff members who were certified, teaching certified as a paraprofessional. We moved them, if they had a teaching certification, into a teaching position because we needed additional staff members to do virtual learning. So we have had a cost for that. And then midday transportation for the elementary buildings is an area that we've had quite a few expenses in. And unemployment compensation, even though we paid all of our employees, we still did incur some unemployment compensation. We are contesting some of the ones that we don't feel should have been paid. But as of right now, those are real costs that we had. And that's the smallest area, $255,000. So altogether, since March 13th, we've spent $1,738,000 on COVID-related expenses. Okay. The middle section shows the grants that we received. So some of these grants had a retroactive date back to March 13th, but we might not have gotten awarded those dollars until well after. So the Delaware County Council CARES funding, $416,825. It does have a retroactive date back to March 13th, but we didn't actually get notification of that grant until after our audit was complete. The PDE ESSER funds, the CARES funding, the $327, and the PCCD COVID Safety CARES grant funding of $263,668. We talked about that earlier. That is included in the surplus that we looked at. We received that grant. Those both had retroactive dates back to March 13th, and we did receive them and included them in the audit report for June 30th. The special education COVID-19 impact mitigation GEARS CARES funding for $5,000. That grant it starts September of 2020, so that doesn't actually fall for last year. And those dollars can't be used to supplant. So it has to be for new services related to special education that you would not necessarily have purchased in the past. So all in all, we've received $1,012,913,000 worth of grants. If you look at the third section, the potential additional costs, that's from November 1st of 2020 to June 30th of 2021. Keep in mind that some of these costs may or may not materialize. When we were looking at the technology costs, for example, the $500,000 to the $1.3 million range, we were looking at things, if we receive grant dollars, that we would definitely do. So we applied for some additional grant dollars. We don't know if we're going to receive it or not. In the event that we don't receive those grant dollars, we'll go back and look at all of the things that we included on this anticipated cost for technology. and identify the ones that are most important and are absolutely necessary to complete. The same
Okay.
with the PPE and building modifications, we have a range there. We have several purchase orders that are still open for PPE items that we know that we need to receive. We're in the process of going through our current inventory of PPE and sanitation supplies and equipment, and we likely will incur some additional costs between now and June 30th of 2021. And then
Michelle,
I just want to jump in. Or just want,
Yes.
I'm sorry. I just want to jump in and say, but the potential of grant dollars isn't going to dictate what we do next too. The reason there's a range too is we're going to continue to do what we need to do to make sure we're delivering, the best education we can for our students in Radnor. So depending which phase and how long we stay in the phase, we may continue to make adjustments in each one of the phases. And so that's why there's a range in each area. And we're not limited by the grant dollars. We certainly hope additional come through, but at the same time, if there's something we need to do that we believe will improve our program, we're not going to hesitate to look seriously at it.
Thank you, Mr. Batchelor. And I just want to say, just in the interest of time, because I know the GRCC meeting needs to get underway. It's pretty self-explanatory, Michelle. I really do appreciate you have it laid out in a very digestible format. Do committee members have any specific questions? Yeah, Nancy, go ahead.
This isn't so much a question. I think this is very helpful to take a look at. Is there any way that we can have two different columns so that we can separate which fiscal year we've seen these? Just as we're looking at audits, it would be helpful just to see where these expenditures fell in terms of last year versus this fiscal year. And same thing with the grants.
I can certainly look at doing that. That's not a problem.
It's not critical, but just helpful as we go back and look at stuff just to know when things occurred.
Right. Bradley, did you have your hand up quickly?
Well, we all did. Amplifying that question, I think it'd be great to hear or see some of the detail behind these estimates, and not urgently, but I think as we move forward with the budget for next year, that'd be very helpful. And Mr. Batchelor or Mrs. Deco, whoever can answer this better, ballpark, is there a sense as to whether there's a big difference between phase 2 and phase 1 for what it would look like for expenditures if the district were ever to go into phase 1?
Some of the things that we're looking at to move us to phase 1 could require additional staffing, could require additional desks and spacing and things like that because of what we'd have to do in the cafeteria. When I say additional staffing, it's a wide range of support staff, potentially to even in certain areas, we may look at instructional staff as well. There could be some savings as well. We've talked about the bus run that can, that we're paying, we're paying staffing for an additional bus run right now with our half day. If we move away from that, we may need some of that staff during the day, though. Some of those same staff who run the bus runs, we may use to help us in the cafeteria and to help keep, or the many cafeterias we'd have to create. So yeah, there are areas that are going to impact us, and there are areas that will change at each level. So it's kind of a broad answer. Sorry, I don't know how that's specific.
I understand it's hard to get granular at this stage. So roughly speaking, there could be some additional expenses, but on the other hand, it doesn't sound like you're saying phase 1 is twice as expensive, or something of that magnitude.
No, right now we have not. Finances is not, and the funding necessarily is not what is preventing us from moving to one phase or another.
Sarah, did you have any questions?
I did. I just wanted to clarify. When the PPE built and building modifications, I kind of assumed signage and partitions are already up. Do we anticipate really having much more of those, or is the PPE really much more about the actual PPE category in terms of expenses going forward?
Some we may add additional, depending what we do in cafeterias, we may be adding, and some of it, and Michelle might know this better than I do, some of it's also refresh. There's refresh and there's additional supplies that we want to keep, at hand.
Okay. And then and obviously we don't have to get into the details tonight. It probably belongs more in curriculum, but just given what we've spent on technology and all the new equipment we've purchased and the new internet connectivity, I was kind of surprised there was that much more still being contemplated being spent this year. So it'd be helpful, if that really is going to come to pass, if maybe we could hear just a little bit more about it.
Sure, we could give, and there's things we're investigating. We're realizing, middle school and high. Just give you a small example. Do we need better speaker systems? Do we need a better system where a teacher wears something that's picking up their voice, and then something so that the students who are at home zooming in and the students that are in the classroom, everyone can hear better. So
Okay.
there's a lot of things we're looking to try to fine tune, that even if we're in phase 2 or we're in phase 1, the middle school and high school, either phase, that still comes into play. And some of those sound systems, I have to tell you, would be things that are very valuable post-COVID as well. There's a lot of merit to those systems, individual classroom systems for learning and for students' ability to hear what's going on in the classroom.
Okay, great. That's helpful, because when I saw computers and tablets, I was like, wait, we bought all the computers and tablets. So it's really much more the accessories and the improvements. I got it. Thank you. That's helpful.
Okay, so let's see. I just want Michelle, thank you again for this. I do want to say I agree with Nancy. If you could kind of break this down by fiscal year, I do think it's going to help us kind of match the dollars and what have we already spent? What's already on the books, because we just looked at our audit, our draft audit, and what of this should we expect to be seeing as part of the 2021 final numbers. That's one thing. I will say, thank you for pulling this together. I'm feeling better about having a $2 million budget surplus from last year, because this is a big delta of another, 2 million, potentially $2 million. So, I think it's important that, we have a good understanding of that. The one question I have, Michelle, is, I know that Delaware County, there's talk that perhaps they're considering giving some additional CARES funding. And do you have an update on what the possibility of that might be? I know you prepared a grant in the event that they decide to do that.
So just before I left work today, I received an email from Ed Norris, who works at DCIU, and he has actually been the contact for the Delaware County CARES grant funds.
Mm-hmm. Sure.
And the email stated that the commissioners voted to put it on hold at the current time for a variety of reasons. So I don't have any more information other than that little bit that was included in the email I received late this afternoon.
All righty. Well, thank you for that. Okay, so I don't think there's any action for us to do with this. I do think this is helpful. I think we can probably talk at leadership about whether or not, if sharing this at finance was sufficient, but I do think some feedback that you got from the committee is helpful tonight. So thank you. Yes, Mr. Moore.
I'm sorry, I just thought of one other thing. Mr. Batchelor, when we were talking about, I think this came up in our public meeting when we were talking about athletics and high risk athletics and whether testing could have helped with that. These potential additional costs, I don't see anything about COVID testing in there, and I understand that that's hard to ramp up and could be expensive. So for whatever the next round of setting out what these estimates look like, if you could give us the current state of play of how much some kind of testing program for COVID would cost, I think that could be helpful. That's the kind of thing that could really influence our ability to do things like move among the phases and continue a lot of our programming that is higher risk.
That's a great point, Bradley. Thank you for bringing that up. All right, do we have any new business? And Mr. Batchelor, do we have any public comment?
No additional public comment.
All righty, well, thank you everyone in GRCC for your patience. I'm going to adjourn our Finance Committee meeting. Thank you, everyone.